This is Demel Gonzalez of Heartwood Financial Services. Thanks for joining me for our latest market update for November. We'll also be touching on December. Kind of hard not to, right? The news has been pretty heavy with omicron and the Fed change in tone. So we're going to be talking about all these topics and how it affects you and your portfolio. So thanks for joining me. If this is your first time here, welcome. Hit subscribe. Put comments down on the bottom. If you have any questions, we'll take a look at those and try to get back to you. If you've been here before, welcome back. Thank you for joining us, and I hope you all enjoy it. All right, as always, we like to start with the asset class returns. So looking at the charts here, you can see that last month, the month of November, was a negative month. And it was mostly led negative by the international stocks. You can see here, developed international down almost 5%, emerging markets down about 3.5%. Emerging markets is actually even a little bit down for the year. Pretty amazing. Most of that led by what's going on in China. They're just going through a huge restructuring. And every time there's some COVID variant, we all know that the emerging markets, being that they have the lowest vaccination rates, they're going to probably have the most shutdowns. They're going to probably suffer the most with these new variants that have been coming out, which we'll talk a little bit more about in the outlook. But large cap stocks held up pretty well. You can see it was only down about 1%. The S&P 500 is really mostly, well, shouldn't say mostly, but it's a big chunk of it is tech, and tech actually did really well last month. Although if you're watching this here in early December, you've seen that tech has had a huge turnaround and is actually doing a lot worse here in the last few days starting December. Interesting, what goes up sometimes comes back down. Mean reversion. So large cap still doing pretty good for the year, up 23%. Small cap as well, still doing great for the year, but down a little bit more, about 2.25% for the month. Real estate again, been the leader for the whole year and only down about 0.8 for the month. So held up and holding up as well in the last few days a little bit better. On the fixed income side, you can see, you can barely see actually the U.S. fixed income was barely up, and it's down just a little bit for the year. Actually, recently doing a little bit better because of some of the concerns out there with the Omicron variant. High yield down a little bit as well, but again positive for the year. And commodities, interesting conversation here. I don't want to get too long-winded, but it was down considerably last month. So the biggest concern over the last few months has been inflation, and commodities is tied in directly to inflation. So as you can see here, with commodities being down considerably for the month, it's showing that maybe inflation is peaking. We'll see. It's interesting now. The Fed is starting to talk more seriously about it, which we'll talk a little bit more in the update as well. So that might be short-lived. We'll see. Gold was actually down as well, but not quite as much. So commodities actually got hit pretty good, but have been doing pretty well for the year. And if inflation continues to persist, will probably hold up pretty well. Historically, that's basically the best place to be when there's high inflation. So that's the asset class returns for November. Well, just as it seemed like we were starting to turn the corner on the Delta variant, and we were starting to show really good signs with the economic numbers, the market was happy. November started off with a bang because of that. Then comes the Omicron variant. It's almost like the Empire Strikes Back. If I had the music, I would play it. But basically, the concern is we don't know a lot about it. It's too early to tell. It was just first detected in South Africa last week. And so when there's lack of information, the market is unhappy. It gets very volatile. As you've seen the last week or so, there's been lots of swings up, lots of swings down, a little bit more down than up, unfortunately. And so anecdotally, what I'm seeing from the Omicron variant is it does look like there is going to be some effectiveness of the vaccines. That remains to be fully tested, but it probably won't be as strong as the current variants, but it'll still have some effectiveness. And so far, I haven't heard about any hospitalizations or deaths due to the Omicron. So this could be just a much more contagious, which is one of the things that they do feel more confident about, is that it's a lot more contagious. But if it's a lot more contagious and maybe not quite as, what do they say, virulent, high mortality, then maybe this is getting a little out of hand. The market has definitely been pricing in another Delta wave with potential multiple lockdowns and restrictions, which we have seen a little bit of that, but maybe they'll be short-lived. And so I'm probably more in the camp of I'm going to be concerned until I find out a little bit more information, but I am cautiously optimistic with some of the anecdotal evidence that's been coming out recently on this. Also recently in the news has been Jerome Powell. He is the Fed chair, which just got renominated. So now maybe he feels a little bit more confident to tackle things the way he really wants to instead of trying to play a little politics. Maybe there is a little bit of politics with the Fed, especially when they're getting renominated by a new president. But anyway, the news is what seems like on the surface a big turn in the Fed's take on the stimulus programs that started back in the depth of the pandemic. So there's two things going on. The Fed has been at lowered interest rates, okay, and then they went out and started buying bonds in the open market to lower interest rates on the existing bonds that were out there too, and that just put a lot of liquidity, a lot of cash flowing around in the marketplace, and that's been very helpful for the economy to kind of soften the landing of the pandemic. And now they're talking about pulling back the reins a little bit of that taper. We talked about the quantitative easing. We talked about that last month. But what he said today was a little different. He says, well, inflation is getting a lot more out of hand than we originally thought. He even said he thinks he wants to retire the word transitory. I think some people read a little bit more into that. I think transitory is just a word that most people don't have the same meaning in their head. So he didn't like the word and he's going to retire it. But the timing of it is also basically saying that maybe it's not the most appropriate word because it's going to be around longer and more persistent. And so what you're seeing the Fed do right now is they're starting to say, well, maybe we need to taper, which means stop buying as many bonds a little faster than we originally announced just a couple weeks ago. And so the Fed, the market, I should say, is throwing a little bit of a hissy fit. In fact, right now, I would say based on how I'm seeing interest rates moving, and the different parts of the stock market moving, I would say the market is more concerned about the Fed and what they said about a faster tapering, which would then possibly mean that the number two thing, remember there are two things, is the bonds and the interest rates. So maybe they'll start raising interest rates sooner, okay? And when they raise interest rates sooner, that could slow down the economy. And so it's kind of interesting. Why would the Fed start talking more aggressively about pulling away stimulus when there's this variant that could be out there and could slow down the economy? Well, I think right now they're probably not as worried about Omicron as maybe the news media is kind of stirring up, the fear out there. Until we know more, but I would say that's definitely more along the lines of what they're thinking. If Omicron tends to be worse than we currently are expecting based on some of the anecdotal evidence, then I got a feeling the Fed is going to pull back some of the language that they just made, which means that they're going to be slower to pull away that stimulus. Why is this such a big deal? Well, we'll talk about that next in the Heartwood implications. All right, so the events of the last week or so has completely changed a lot of the investment thesis that I had going in to finish up the year. So we have the Omicron, which is going to favor those shutdown stocks, the stocks that tend to be more tech type stocks, because they're the ones that survived when we were all locked down and we couldn't move around as much, like the Zooms and the Amazons of the world. Okay, and then when you had the Fed saying that they're going to be more hawkish and they're going to maybe even raise rates, people speculate, of course, that they may raise rates sooner. Well, that hurts those growth stocks because they're very interest rate sensitive. And so which way do you go? Which one is going to win? Is the Fed going to be hawkish and Omicron is going to be bad? I don't think so. I think it's going to probably be, if Omicron is bad, the Fed will pull away that verbiage of being so hawkish. Okay? If Omicron ends up being not that big of a deal, the Fed is going to stick to their guns and try to be more hawkish. So what is going to happen? Okay? I don't have the answer to that. My hunch, based on just some of the anecdotal evidence we've seen so far, and again, we have to be very fluid and on top of this because this can change, and we're going to find out more here in a week or two of how the vaccines are doing against this new virus. We got to see, what's going to happen with that Omicron variant. I think it's going to be, it looks like it's going to be more contagious, but maybe not as dangerous. And so if that's the case, we could be more on this hawkish march for the Fed to try to fight inflation. They are very concerned about inflation, and the administration is really, they've been awakened to this, and they're making it a big deal. It's on the news all the time about how inflation has been picking up. Now, the good news, it does look like inflation is starting to maybe peak, but it's a little too early to tell. And so maybe the Fed will back off if the CPI number next week is not as high. But again, lots of things are very fluid here. It can change. So what does that mean? We got to stay diversified. We got to stay with those growth stocks just in case the Omicron hits. And we got to stay with some of those cyclical, more value stocks that tend to do better when there's higher inflation and higher interest rates. And so having that balance is important. That's basically where we are right now. And the other thing that I'm doing right now is just being a little bit more convicted in doing the sales of some of the stocks in the rebalancing trades that have been coming up because, stocks had done well up to maybe just a few days ago, and just selling off a little bit, getting a little bit more cash and a little bit more in bonds just to have a little bit more of a cautious stance. But again, still optimistic for the rest of the year and 2022. But there's right now a lot of things to be watching and to be concerned about. Thanks a lot, guys. Thanks for watching. I hope this was helpful. If you have any questions, which I doubt you would, right? I explained everything perfectly. Please call, please email, and of course, I'm being facetious. Reach out to me. Happy to chat with you and explain a little bit more of what we're doing. Thanks, and have a good one.